I-bonds explained. Hedge against inflation. While rising inflation has obvious downsides. Hello, exorbitant grocery bills. The rise in prices of goods and services is making one investment increasingly appealing: savings bonds in Series I. What are I-bonds and how do they work? Can I-bonds really help me during inflation? We'll find that out and much more in today's video. What are I-bonds? I-bonds are a type of savings bond that is intended to protect the value of your money from inflation. With inflation at 4-decade highs, investors are looking for higher returning, lower risk investments, and this type of savings bond fits the bill. Otherwise known as I-bonds, these virtually risk-free investments already have a lot going for them. They're backed by the US government. Their value doesn't fall. They offer tax benefits, and perhaps most importantly, they currently pay more than 7% in interest per year. What makes that better is that inflation is expected to boost the already high return even further. Are they the same as TIPS? No, I-bonds are not the same as Treasury inflation-protected securities or TIPS. Although just like TIPS, the amount of interest paid on I-bonds adjusts based on the rate of inflation. In contrast to TIPS, I-bonds are low-risk investments that are typically sold to retail investors. They, like traditional savings bonds, are available directly from the United States Treasury. Also, like all savings bonds, I-bonds are not traded on a secondary market and cannot be transferred. In other words, they must be redeemed by either the original purchaser or the estate of that person. Because of their low default risk, Series I bonds typically pay very low interest rates in comparison to most other securities. They are, however, exempt from income tax, as are most municipal bonds. The interest on the majority of other fixed income securities is taxable. What's the deal with I-bonds in 2022? Professionals have recently forecasted that I-bonds will offer a 9.6% annual return in May, based on March Consumer Price Index data released recently, which shows inflation has risen 8.5% year-on-year. Although, of course, these are just estimates. I-bonds benefit from this increase because they pay both a fixed rate return set by the US Treasury Department and an inflation-adjusted variable rate return, which changes every 6 months based on the Consumer Price Index, which makes it the best front to protect yourself from inflation. One thing that you need to keep in mind is that you cannot purchase I-bonds through a brokerage account. Instead, you'll have to go through the US Treasury Department's website, and there is a maximum amount that can be invested. In general, you can buy more than $10,000 in I-bonds per year, plus an additional $5,000 if you invest your tax refund in paper bonds. I-bonds mature after 30 years, which means you can keep earning interest on them for the next 30 years unless you can cash them out first. While they can be redeemed as soon as 1 year after purchase, cashing them out soon, specifically within 5 years, means forfeiting the last 3 months of interest earned. For tax purposes, you can postpone declaring your interest until maturity or cash out. How do I-bonds adjust with inflation? Inflation-linked savings bonds are linked to changes in the Consumer Price Index, CPI, a long-standing measure of inflation published by the United States Bureau of Labor Statistics. The Consumer Price Index tracks the price change of a basket of goods and services over time, such as food, commodities, healthcare, and transportation. It differs from PCE inflation, which is the preferred inflation figure of the Federal Reserve of the United States. In comparison to the CPI, the PCE number tends to show slightly lower inflation. The CPI figures are published monthly, and the BLS keeps track of the CPI results over time. How to calculate the interest rate? I-bonds use a composite interest rate, which is made up of 2 parts: a fixed rate set as purchase that lasts for 30 years, and an inflation rate that changes every 6 months, usually on the 1st of May and November. It's not as simple as adding these 2 rates together to get the composite interest. Instead, the formula is composite rate is equal to fixed rate plus 2 into semi-annual inflation rate plus fixed rate into semi-annual inflation rate. For example, the composite rate for I-bonds issued between May 2021 and October 2021 is 3.54%, which includes the 0.00% fixed rate and the 1.77% semi-annual inflation rate. What's in it for you? Alright, before we continue, go ahead, click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Also, tell us in the comments section why you would consider investing in I-bonds. Thanks. Now back to the video. Just like what we mentioned earlier, the main advantage of I-bonds is that they protect your cash's purchasing power from inflation. When prices rise throughout the economy, the purchasing power of the same amount of money decreases. But safe investments such as I-bonds can help you maintain the value of the cash component of your asset allocation. As security issued by the United States Treasury carries almost no risk of default, and as previously stated, I-bonds also provide attractive tax benefits. For example, their interest payments are exempt from state and local taxes, and they may be completely tax-free if used to pay for college tuition and fees at an eligible institution. I-bonds are popular among conservative investors, according to Mark Scudillo, managing officer of Eisenamper Wealth Management and Corporate Benefits LLC. He also stated that buying I-bonds as an alternative or in addition to 529 plans, which also grow tax-free for qualifying higher education, is a good idea for middle-scale earners. What's the catch? In a way, before redeeming an I-bond, an investor must hold it for at least 12 months. An investor can redeem their bond after the first year, but doing so before 5 years has passed will result in a penalty equal to the previous 3 months' interest. If you redeem a bond after 18 months, for example, you will receive the principal plus the first 15 months of interest. How to purchase and sell I-bonds. I-bonds can be purchased electronically through the Treasury Direct website. You can also use the proceeds from your tax return to purchase up to $5,000 in paper I-bonds per year. There is no secondary market for trading I-bonds, which means they cannot be resold. Instead, they must be cashed out directly with the US government. As for redeeming I-bonds, you can do it through the Treasury Direct website, whereas paper bonds can be redeemed at a nearby bank. What to think about before diving in. Cashing out I-bonds in less than 5 years means you'll miss out on the last 3 months of interest, but the return is so high that it's likely still worthwhile when compared to other savings vehicles such as high-yield savings accounts and CDs. However, it's worth noting that I-bonds are generally regarded as long-term investments with a consistent return. Because your money will be locked up in I-bonds for at least a year, you can consider a short-term CD such as the 3-month Brio Direct High-Rate CD or the 6-month IGO Banking High-Yield IGO CD. If you need something more accessible in the near future, as in within a year, choose your CD term based on how quickly you need the money. Another option is to use a top high-yield saving account, such as the Marcus by Goldman Sachs High Yield Online Savings, or another option from a large bank, such as the American Express High Yield Savings Account, or a Barclays Online Savings Account. Given the $10,000 maximum limit, high net worth investors should consider whether I-bonds has a significant impact on their overall portfolio. It probably doesn't make sense to open one if the amount is so small. Bottom line, is it worth to invest in I-bonds? If you're looking for a risk-free yield and protection against inflation, I-bonds may be a good fit for your investment strategy. Most of the time, if something seems too good to be true, it is. However, every once in a while, something does check out, and I-bonds are one of those rare occasions.